learn Business 101, the boring stuff, which we should probably also title in a longer version, Business 101, the boring stuff, but also the necessary stuff. So I am going to let our 4 panelists introduce themselves. We're having a little issue on our startup events calendar right now, but for future reference, if you go to startupspokane.com, we do have an events calendar that you can check out for all of our upcoming Lunch and Learns and Ecosystem and Entrepreneur Connects. If you have any questions on those after this, feel free to let me know. Otherwise, I'm going to pass this over, starting with Mary.
Hello, I am Mary Mcdermid. I'm a financial advisor with MassMutual, and I have office hours here at Startup Spokane. I'm very passionate about helping, mentoring, doing all those things for people that are just starting a business. I'm always very transparent. I'm 3 years into having my own business, so I, on my profile, said, come ask me anything. So obviously, in this setting, I'm talking about group benefits and then how to protect yourself in partnerships. But if you're like, how do I get through this crap day that I'm having and come up on the other side, I also would be able to answer those questions as well. So,
Hi, I'm Jason Powell. I'm a partner with the law firm Kara Stone. We have offices in 7 locations around the country. Most of the attorneys focus on corporate and security stuff, so we help companies all the way from formation through the exit of the company and kind of everything in between there.
Hi, I'm Suzanne Weathers. I'm the owner of Weathers & Associates Consulting. We're a tax practice. We specialize in tax debt particularly, and so you can be proactive in your taxes is what we do with the education is so that you are in that seat, or reactive, and I will see you later when you have a problem. So.
Hi, I'm Jane Larson with Washington Trust Bank, and I'm a small business banker. So what I do is I work with small businesses from the startup phase on through the mature life cycle. So we can help you with all of your financing, from initial financing to lines of credit, loans, and real estate. So I'm looking forward to seeing how we can help you. Thank you.
And now that makes sense why they have those.
yeah, I was like, that's pretty loud. At least a couple come in. So we're just getting started. Come on in. Yeah. Okay, so we're gonna just take each section at a time and talk about those sections. If you guys want to write down your questions and save them to the end, or if something's like just can't stop and you have to ask it, then go for it. But it's helpful if we can do it all kind of towards the end. So I'm going to start it off. I'm the first one on this in this packet. It's a business strategies work plan. So it just kind of has some checky boxes on the back. So what stage are you in? What should you be thinking about? And what it pertains to. So business planning, risk management, business succession, personal protection planning, and then employee benefits. So today I'm going to talk a little bit more about the employee benefits, just because that is what I get asked about the most in this setting. So group benefits, health, life, DI, and retirement planning are the big 4 that people want to plan for. And most often when you want to add a benefit, let's say health insurance, it's usually because a owner could probably maybe absorb their spouse, or your spouse no longer has health benefits that you were on, or different type of scenarios where the person that you were on the health benefits for, you no longer have that. So you need to find your own as a business owner and therefore provide it for also your employees. It's more likely cheaper to get it in a group setting than it is to try and go out on to an individual plan. Even if you're a one of one, a one of two company, you can still get a group benefit because you are a company. So the health insurance portion is, usually the most sought after, just because that is what the business owner needs. And I always tell people, and these guys will probably attest to that, if it doesn't, is it not important to you as a business owner? You're not probably going to go through with it. So I say if you want a benefit, then it's got to be important to you. Unless some employee of yours has come to you and said, hey, I'm not going to work for you unless you have a retirement plan, or I'm not going to work for a company that doesn't offer X. But usually you don't get that out of your employees, whatever stage you're in. Life and DI, you can do that in the group settings too. Also, it's based on wages. So if you're not paying yourself, it doesn't make sense. So you have to actually be getting money from your company to have those kind of benefits because they're based on a wage. And then retirement accounts. Most smaller startups would start with something that's called a simple IRA, and it sounds just like it is. It's a simple IRA. Did I break this? Okay. It's your account. It's your account from the beginning. There is a match requirement for that, which would be the company would have to put a 3% match in to have the individual also put 3% in. So that is a requirement of a simple. But you don't have to have a TPA. You don't have an accountant on the backside trying to make sure that all that stuff is accurate on the back end on the accounting side. So on those fees, it's less. But just like most of the groups I have, they're only 2 to 50 employees. I only focus on companies that are in the smaller stage because I can relate to them. And that's where I like to hang out. The other part about it, and this is what Jason will talk about a little bit, is if you are in an actual partnership. So if you have a partnership agreement, there are 4 things that need to be covered. 2 of them can be covered with insurance. The other 2 you kind of have to figure out. But death, disability, divorce, and when you want to be done. Does that sound right? So if you cover those 4 in a partnership agreement, you're pretty covered. The first 2 can be covered by insurance products so that you don't have to define it in the contract. When you define it in the contract, then you both can dispute that. But if it's in an insurance contract, there's no disputing what's in there usually. If you want to be done, that's a whole other thing. And if you are in a partnership with someone who is about to get divorced, you better hope that they have some cash on hand. That's the advice that I give. And then I send them to you to make sure that all those documents are actually accurate. So that's a really high level of group benefits. And I'm here every other Friday. I have office hours just hanging out to answer questions. So that's about it.
I have 3 different handouts in the packet. I'm going to go through them kind of quick. I'm going to start with the one that's called Business Entity Comparison Chart. And this is just a high-level chart. Can you hear me? Is that better? Sorry, I wasn't holding it close enough. So on the Business Entity Comparison Chart, this is just looking at the different entity structures that you can begin your business with. The first one there, sole proprietorship, and I put that on there for the only reason that if you look down at the 6th or 7th gray box there where it says owner liability, on a sole proprietorship you have unlimited exposure. In 11 years practicing law, I've never once told a client to continue going as a sole proprietorship, because essentially what that means is if you were ever sued and lost that lawsuit and had a judgment against you for, say, $100,000, all of your personal assets are available to be taken in that lawsuit. That's one of the reasons that companies form entities, is for that liability protection. And as you look at this chart, one of the other things I just want to point out that a lot of people don't realize, I know S corporation is listed on here separately, but an S corporation is just a tax designation. So an LLC can be taxed as an S corporation, and then a regular corporation can be taxed as a corporation, a C corporation, or as an S corporation. Are any of you guys in here currently are anticipating raising capital at any time in the future? No. Okay. So the other chart I have here, and so I'll just briefly touch on this because it's not going to be relevant if you're not looking to raise capital. But if you are, you know somebody who is looking to raise capital, one of the important things to remember is that when you're selling an ownership interest in your entity to an investor, whether it be an LLC or a corporation, you are actually selling a security. And when you sell securities, those securities either have to be registered with the Securities and Exchange Commission, like a public company securities are registered, or you have to have an exemption for the sale of those securities. If you don't fall underneath one of those kind of exemptions, the Securities and Exchange Commission, as well as the Washington Securities Agency, can come knocking on your door, and that is the situation no one wants to find themselves in. I've had multiple clients who haven't done things right, and have spent a couple years being investigated for failure to follow securities laws. So the one I want to spend the most time on is there's one called the top 5 legal mistakes made by startups. The first one there touches on the partnership agreement that Mary talked about. Generally speaking, I don't call it a partnership agreement only because when you have a limited partnership, that agreement is called a partnership agreement, so I like to refer to it as a founder's agreement. So I'll give you one example of why this is important to have. I have a client out of Montana who the entire idea and the entire capital for the organization came from one individual to the tune of like $200,000 of capital she contributed. They did not set up properly in that they did not have a partnership agreement, and so they just kind of divided equity up and didn't have you didn't essentially have to do any services or contribute capital for your equity. Well, the founder, who had the idea and also contributed $200,000 of capital, very soon found herself in a minority position, and essentially kicked off the board of directors, voted out as an officer, and basically out of control with little to no recourse against the other individuals because they did not put a founder's agreement in place up front. So that is extremely important if you have essentially more than one person who you're founding a company with. The second one is not forming a limited liability entity. That goes back to, making sure that from the start you've got an entity in place. Most of the time I advise clients when forming an entity that there's a certain number of questions we got to go through, but I also advise the client to communicate with whoever is doing the company's books or the accountant before forming a company to make sure that we're forming the right company for you, because it can be difficult down the line to convert an LLC to a corporation or convert a corporation to an LLC if we didn't establish things right on the front end. The third one is not protecting your intellectual property. So this applies to trade secrets, trademarks, and patents. If any of those issues are applicable to you in your startup, the most important thing to protect your intellectual property is making sure that all of your agreements with anybody who does any work for you, whether they be an employee or a contractor, have language that assigns the intellectual property that they're working on to the company. If you don't have that, that individual, whether it be an employee or a contractor, has certain rights to that intellectual property, and if down the road you ever went to sell that intellectual property or raising capital, that issue could come back and be a big problem in that process. The last one, the fourth one, I think Suzanne's going to touch on this, is having proper employment procedures in place and understanding the difference between contractors and employees. And the last one is not hiring an attorney from the start. And whether or not that's me or somebody else, I strongly encourage you to get one in place from the start. I mean, I realize that in most cases, the formation of a company can be done by LegalZoom and other companies out there on the internet like that, and they're good at the basics. But if you need any sort of customization in the documents when you're forming them, those services are not the best for you. And I've had too many experiences where people use those organizations to form and do their contractor agreement or employment agreement, and then down the road we have more cleanup to do, and it's more costly to clean up than if you'd gone to an attorney in the first place and set things up properly rather than using one of those services. And with that, I'll let Suzanne take over.
It's funny, Jason said to check with your tax person about your corporate structure, because I'm one of the few tax people that will not make that decision for you. I can tell you tax consequences so you can make an informed decision, but then I tend to send you to Jason. And with permission, there have been times that we've discussed what do you need, and then we can have a clarifying conversation. So that's one of the things that having professionals on your side right from the get-go. So I have a couple of pamphlets in there also, with some basic tips. There's some distinctions between different types of tax preparers. Not all are licensed. You don't have to have a license to prepare taxes for a fee. But I'm an enrolled agent, and my practice specializes in actually representing clients before tax agencies, mainly the IRS, the most common known one. And so I see a lot of people probably at their most stressful point in their life and when mistakes have already been made. So part of coming and talking is saying these are the things the most simple things. I'm 2 years into private practice, 2.5 years. I'm going to raise my hands. I've made some mistakes. It's as simple as that. I've advised business owners for a lot of years, and you might want to say, when you have no children, you say, my children will never. I'm feeling those experiences right now. So a little humility goes a long way in this world. For me, knowing what your corporate structure is from the very get-go is very important, and I'm sure Jane will talk about the banking aspect of that, but there's also that separation. So they talk about the corporate veil. When you're dealing with financials, you want to keep that separation between your personal finances and your business. Even if you choose to be a sole proprietor, you should be setting up with an EIN number, so that's a tax ID number for a business, and at minimum have a separate account, a business account. It makes so much more substantiation if you were to support your income and your expenses. So we're hearing a lot about the gig economy. That seems to be a buzz phrase that people hear about. And one of the parts of that, as I'm working, that a lot of times you're a single person and this is your business and you're out there pursuing profit, and you legitimately are, but how do you prove that? You're going to need to prove that to a taxing authority, so the IRS, and to banks if you want funding, if you want to maybe get a mortgage down the road, and so on and so forth. So it all comes to keeping clean and concise records from the get-go. You know about your income. So if you are receiving money, all monies, cash, checks, whatever, should go directly as a deposit. Is that going to be inconvenient when you already have a 20 sitting in your wallet and you could use that because you're going to meet people up at the end of the day? Maybe, but if it's part of your routine, you can always state, I always put all monies into my account, so therefore we know what is income and what is taxable. And then all of your expenses should come out of those business accounts, whether you use a debit card, credit card, or whatever method. Expenses are expenses that are generating revenue, right? It's not, the tax code is never intended to supplement your lifestyle. And that's where we have a little bit of a problem with some people that will come in and they'll go, but my uncle had a business and he said I could write off this, that, and the other. And it's like, great. It just maybe means that your uncle has never had to sit across from the desk with a revenue officer and say, now show me the receipts of anything that you've purchased $75 or greater, right? So that's at the most simplistic level. If you are introducing employees, things can get pretty dangerous pretty fast when it comes to taxing. If you are not paycheck, your employer or yourself have held back taxes, because that's what is stated on the employee's wishes are that you withhold so much for going to pay for Social Security and Medicare. So we're all familiar with that. On the back end, as an employer, you are making a deposit equal to the amount for Social Security as your is a trust fund deposit promised to employees, and you are a nasty little word to use around an attorney is fraud, right? And it's not a good situation to be in. Because it's serious, penalties that are calculated on not making those deposits or not even filing the paperwork correctly range from 10% to 25% immediately. And so that amount of money can quickly increase and compound and cause problems. So, is my best advice, or considering an employee, you make sure your first pay, not necessarily reconcile them as much as we should and say, okay, I've got this much in my account. Well, then the end of the quarter comes and I see where business owners say, carving it off, that money would have been sitting. Gosh, where am I going to come up with $15,000? Okay, so expanding your business, you have to be aware of what it really costs to have an employee and of that part and parcel. And then the last part of all of it, truly understanding what you actually can take as a deductible expense when it is being seen as a digital number, like just a digital number when you actually file your tax return. So each business has a classification code. They're NAIC? NICS code. Your NICS code, yep. There's an I in there, or there's a C in there, or it throws me off. Okay, so there's a code. The first year you file your taxes, because we don't revisit that kind of thing typically, right, can actually set you up for failure. So if it just means that, we respect what's inspected, and that's how the IRS operates, in theory. And so it might just be your time to be reviewed, but that is one of the things, the same as claiming deductions, expenses that you're aware of. Taking deductible expenses are expected. I will tell you, as signal showing what your bottom line income is not something that you should be practicing, especially if you're qualifying for a means credit. If you are manipulating your income through your expenses, taking or not taking deductions and such, to put you in a specific place, that can come with other consequences too. So, wise counsel in all of these areas, and what you can be doing or can't be doing. You can always dial the IRS, or you could just, touch me on the shoulder at any event that we probably have brushed shoulders at. So.
The planning is so important in the success of your business. Part of that planning includes making sure you're separating your business assets from your personal assets. And that's something that's just going to continue on being more and more important as your business continues to grow. So at banks, you will have the opportunity to do business checking, business saving, which is a great way to move over some of those tax payments along the line to make sure that they're not in your general operating funds and you're not tempted to spend them. So that's on the depository side. My focus is really on the lending side, and that's how do you get your business started? How do you find the capital? How do you borrow money to keep your business going? And so what I want to start first with is traditional bank lending. So traditional bank lending is we look at businesses that have been in business for 2 or more years. You've been profitable for those 2 years. And profitability means it's profitable enough that you can pay back all your debts and you can pay yourself enough income so that you can pay your personal debts as well. So it's not just profitable, it has to be enough profit, right? And that's one of the things we see most often is customers come in and they'll say, well, I make a lot more money than that. I don't always, I write off more than what, it could be my electric bill, my water bill, I'm paying for my car. It's like, well, you really need to show the profit of the business. And we're going to go on that profit of the business, and I can't add back in your cell phone expenses, for example. That doesn't count. So make sure that you're getting wise counsel, like Suzanne said, in deducting the proper deductions. All right. So traditional bank financing, again, you're profitable, you've been in business, you have good credit. Good credit is going to vary bank by bank. For us at Washington Trust, it's 650 for secured credit, 700 for unsecured credit. And that's one of the things I see most often that really takes a hit when sometimes people start businesses, is that they're relying on a lot of credit, and they're relying on a lot of credit cards, and we'll talk about that a little bit later too. But that could be really detrimental to your credit score, so be really mindful of your credit score. The other thing in traditional bank financing is you have sufficient collateral. And most every bank is going to require that you personally guarantee, even if you've gone to the work of setting up an LLC or a corporation, it's you that's making these decisions on how to run the business. Therefore, the bank wants you to stand up and personally guarantee. Say, yes, I believe in my company, and bank, I think you should believe in my company too. So that's traditional bank financing. Well, what happens if you don't have 2 years in business? Does that mean that there's no option? No, there are other options. One of those options could be SBA financing, Small Business Administration. That's a government guaranteed program. So with SBA financing, it's not just for new businesses, it's also for existing businesses that have some sort of weakness in the loan that doesn't fit by traditional bank standards. That weakness could be you don't have enough down payment that the bank typically requires. It could be that the collateral value isn't sufficient. Is that you, Suzanne? So there's a lot of reasons why you go SBA. And one of the reasons could be that maybe we traditionally amortize a loan over 5 years, but it doesn't work with your cash flow. You might need 7 years to get that payment a little bit lower in order for it to work with your historical cash flow. That could also be a reason for SBA financing, because it's shoring up a weakness within the credit that the bank would normally turn down. With that SBA guarantee, we might be able to make that loan. One thing that SBA will not overcome is derogatory credit. So they don't help us overcome poor credit to make that loan. So you got to make sure that you're really focusing on getting that good credit. Now, if you are a startup, we can look at doing some financing for you. What that's going to mean is you're going to have a really good business plan. You're going to have cash flow projections that show us how much money you're going to make. And really importantly, you need to have a lot of industry experience. A startup financing isn't for somebody who says, hey, I've been a teacher and now I want to be a baker. It's something that you've been the manager of a bakery for, 3 to 5 years. And now you're either going to start your own bakery or you're going to buy out a baker. So those are the kinds of SBA financing. Well, what happens if you don't have that? If you don't have traditional bank financing, you're not eligible for SBA financing. How do you get financed? There's a lot of opportunities, and I'm not going to try to touch on crowdsourcing or crowdfunding and those kind of things because it's not my area of expertise. But one of the things I see a lot of people do is they get personal financing from friends and family and personal credit cards. And I just want to touch on a couple of things. If that's the avenue where you get your capital, I just want you to be aware of a little bit of the end game so that you know how to structure that. Number one, when it comes to credit cards, please be very careful. My recommendation would be, if you can, to please get a term loan. Get like an auto loan where they give you the money up front and you make equal monthly payments and it's a fixed interest rate. And at the end of 3 to 5 years, thank you, Jason. At the end of 3 to 5 years, that is paid off. That's super important because it gives you that discipline that this money is going to be paid off. When you do it on revolving credit, such as a line of credit or you get a credit card, what can tend to happen is you're making those minimum payments, right? Emergencies come up, stuff comes up, you're growing. When you're growing, it is incredibly hard to pay down that revolving credit. So please do yourself a favor and get those payments in a term loan if at all possible. The bank may ask, maybe you have a car that's paid off. That could be collateral. Maybe it's your home equity. Maybe it's just an unsecured loan, but that's going to be better financing for you than putting it on a credit card. If you do have to get a credit card, a couple of things. Number one, make sure that it's a separate credit card that you use for businesses only. Because someday you may want to refinance that. And especially if we have to go the SBA route, we need to see all of the receipts for that those were actually business expenses and not personal expenses. So get a separate credit card for business use. Make sure you keep those receipts. The other important thing that I've run into that people don't know is make sure, even if it's a personal credit card that you're using for business, that you put that information on your business balance sheet, okay? You recognize that debt on your business balance sheet as a business debt, even though it's in your personal name. That will keep you eligible for refinancing that debt later with the SBA. So those are a few of the kind of the important things. Again, about credit cards, one of the challenges with credit cards is they're definitely higher interest rate. So that can be, that's going to be economically challenging. The second thing is that can really hurt your credit score. And I'm not sure if you're familiar, but when you have a credit card, it's important to not go over 30% utilization. And what I mean by that is if you have a $10,000 credit card, great. Try not to use more than $3,000 of it. Because you start going over that 30 to 40% utilization, it's going to start dinging your credit score. And in all of these scenarios, when you go to and you want to refinance that debt, if your credit score has dropped, that's going to make it you're closing doors, right? So make sure term financing, if you do have to use a personal credit card, don't go over 30% utilization. Make it for business reasons only, and make sure you put it on your business balance sheet. So, thank you.
And what's the product you would be spinning off, did you say?
Well, basically, we're a consulting business, but we're doing some R&D and product development. And if this product ever gained traction, we'd set it up as its own business.
So I would say in that scenario, it can really be done any time, but I think the last point in time you'd want to do it is when you, really have the product ready to go to market. That would be the last point in time you'd want to do it, although you could do it after that as well. And part of it would depend on, are you spinning it into a wholly owned subsidiary, or are you spinning it off into an affiliated company that may have different ownership?
Different ownership, that would be part of the reason we're spinning it off, is to set it up with different ownership.
So then part of the issues you may run into is if you've got any intellectual property there, and that intellectual property was developed by the current company, is making sure you can get all the necessary sign-offs to assign all the right title and interest to that intellectual property to the NewCo, because especially in situations where you're going to have, potentially a different board of directors and different shareholders. So in that scenario, I would say I would spin it off sooner rather than later.
Before you apply for a patent, for example.
Yes. Because there's a lot of factors that come into play with this in terms of, who is involved in the development of it, and making sure that, if all the people who are involved in the development of it are going to have an ownership stake in the new company, then it's less of an issue. But say, for example, you had, in your current company, you had capital that was provided to that company by a third party who has an ownership stake in that, and that capital was used in part to develop this product. That individual is not going to have an ownership stake in the new company. He may take issue with you trying to assign a right title and interest to it to a new company. He does not have an ownership interest, even though he provided capital that helped build the product.
I think the insights are really kind of more of a personal basis in terms of what are you comfortable with, right? A lot of people that I talk with don't really want their friends and family involved with this because it's like now you're beholden every time you want to go out and have a coffee. It's like, really? Should you be spending that money? So there's a little bit of, there's a little bit of that. SBA financing is fabulous. It gets that debt into the business name. It gives it structure. It gives it, a lot of legitimacy, I guess, and family and friend financing can do that too, but it's just a little bit more loose. And in some cases, having things a little bit more flexible, especially when you're first starting out, might not be a bad thing. So let me ask you, what are your concerns about getting SBA financing versus friends and family financing?
Yeah, I think that there is an appeal to me in having some structure built in, especially as far as assigning that debt to the business. And I think I don't really know what would be involved in establishing that structure if I were to borrow from friends and family. Like, how do you develop an agreement that, is official enough that...
Sure. Jason might have some thoughts on that too, but there's escrow companies, such as in town, we have Adept Escrow. So if you want kind of a little bit of distance in between, you're not writing a check to Aunt Sally, for example, you want to write a check to Adept Escrow, and there's very good accounting of that, and it breaks it down into interest and principal and all of that. There is that. But the underlying note, I would send you to an attorney to create that?
Yeah, and so if I was to advise you about debt from friends and family, the important thing there is to make sure that you've got a promissory note in place where the company's the borrower, your mom or sister's the lender, and that promissory note lays out exactly what the interest rate is, exactly when the maturity date is, and exactly what the monthly payments are, because you don't want to reach a scenario or situation at some point in the future where you thought it was one thing and the person lending you the money thought it was another thing. So if you've got something in writing, that dispels all that confusion that could possibly happen down the road.
And I'm going to address the tax issue on that. Okay, so having a loan agreement is definitely necessary for it to be able to take the expenditure that you'd have on the interest. You capture the principal part of that payment based upon the asset that you purchase, so that would be your deductible expense there. And the lender, if it's a family member, would have an obligation to report the interest they receive as income. Again, using Adept Escrow or an escrow company makes that very simple for all parties that are involved once you have the legal agreement.
One thing I want to mention really quick too, I don't know if there's any thought to that note being a convertible note, which essentially is a loan and then converts to equity. But if any of you are thinking about that loan that could convert to equity is actually a security. So again, you've got federal and state securities laws issues with convertible notes. So if they're independent contractors, I can't imagine a scenario where they would want to enter into an exclusive agreement with you unless you're keeping them busy full time. The one concern you do have though is if they're employed by somebody else and they're doing work on your behalf on either at their employer or on an employer computer, that intellectual property is not yours. It's their employer's.
But what if they're employed full time, but on Saturdays they do research for me who's sitting at home on their home computer?
Then that's fine. As long as they, one thing you probably may want to check, and it's probably worthy having a representation and warranty in your agreement, is that, they're using their own equipment and they have no other agreement in place which prohibits them from doing that, because you don't know whether or not what their employment agreement may or may not say with their employer if they have one.
But as long as I have an agreement with them, it's strong enough, do you think I'm protected? I
Well, part of that's going to depend on whether or not they have an employment agreement with their employer. There could be potential issues if the work they do on behalf of their employer is very similar to the work they're doing on behalf of you, because then it becomes, were they doing it for their employer? Were they doing it for you? But outside of some issues like that, if you got a straight independent contractor and you've got an intellectual property assignment agreement for everything they do on your behalf, that's the best you can do. At the end of the day, it doesn't necessarily prevent them from going out and sharing it with somebody else. But with that agreement, you have essentially remedies built in, the ability to go after them.
Let's just talk about independent contractors. So here's the thing. There have been changes in this has been an ongoing issue forever and always. And I have a handout if you're interested that specifically is directly from the IRS website, right? So it's there for anyone to look if they care to. So an independent contractor is absolutely that. They are independent. So if you are performing work, the company or person you'd be performing work for would say, okay, yep, this is what I need done. You'd agree to a price. You'd agree to a delivery date. That's it, basically. If they are stating where the work will be done, how the work will be done, what location the work must be done in, with the exception of a physical building, you're building a building, so what can you say? That's the location. But if they are really setting times of work and so that person is not an independent contractor. It doesn't matter which way you try to write that. And the way that the tax code writes it is you are an independent contractor if this is 6 points. And therefore, if you're not, you're an employee, which is a lot of times how the tax code works. It will tell you what is, and then if not, you are the opposite. It doesn't lay out what is an employee and if not. So they're very specific on what is an independent contractor. The reason this has become an issue just recently is because a lot of employee business expenses that people may have been claiming as employers are no longer going to be deductible. They no longer exist as of 2018, and a way in which a lot of articles have been written and a lot of the scuttlebutt is, well, yeah, but if you just become an independent contractor, it'll work. So you just can't choose to do that. If you want any more information on that, if you think that you may be developing a business where you're going to be using independent contractors, I'd be happy to talk to you one-on-one. Okay.
Still be 1099. Hold on. Wait.
Yeah.
But, you can be 1099, which means you're almost paying yourself like a contractor. But you can have either way prove that you have the income via the eyes of disability insurance.
So here's where I talk a little bit about doing an owner's drawer tends to be a typical way that most people that are sole proprietors will work, right? I need this amount of money, I'm going to take this and call it an owner's drawer. It is much better for you to develop the discipline of saying, I am taking $1,000 a month in owner's drawers. I'm not going to do that anymore. I'm going to actually develop a payroll and just transfer that money into my personal account at regular pay periods. It shows that there is a way in which you're paying yourself record-wise, and it would still be calculated on your balance sheet as an owner's drawer, with your business structure being a sole proprietor. If you become an S corp, yeah. If you're an S corp or C, you actually have to receive a W-2 paycheck, same thing. So all of those things go into play, but you can still develop that discipline if you're a sole proprietor by transferring X amount of money every month or every 2 weeks and showing that you are paying yourself.
A lot of that depends, quite frankly, on the type of business you are. Trademark applications, generally speaking, they cost about $300 filing fee. Most attorneys will do them for a flat fee of about $800 plus the filing fee, so they can be fairly expensive to do. You could conceivably do it on your own because you can do it online, and they're not extremely difficult to do. Essentially having a trademark gives you more legal protection, but the minute you start using your name, assuming no one else is using it in the industry you're using it in, you do have some common law protections to that name. So I guess, my advice without knowing additional is if you are starting a business that you intend to grow on a regional or national basis, there probably is some benefit to looking into a trademark. If you're starting a business that's going to be local in Spokane and you have no intentions of growing it outside, I would almost say save yourself the $1,000 and just kind of forget about it.
My home office and my studio space, let's say it's 50-50 work.
So on the days you drive to your commuting, the first trip. If you're working from a home office, the discipline would be your first visit would be considered commuting. So your first location, whether it be for purchasing office supplies or meeting with a client, and then subsequent trips throughout the day would be your business miles. The last trip of any day is going to be commuting. So I prefer deduct. No, that's all right. So having a home office, that in itself is complex in the open floor plans that we live in, because you have to be able to attest that it is exclusive use. So are you banging out some emails on your phone at the coffee table, having a cup of coffee in the morning and calling that your home office, or do you have a legitimate lockdown space that is exclusive use?
Lockdown space.
Yeah.
Yeah, but if you do some personal work in this space, you're not allowed to do any personal work.
It's exclusive use, yeah. So if you have, a folder bed in there, or you have TV in there, or Granny sleeps there when she comes to visit, she's on the couch. little chart that was in there, that is the minimum information that's going to be required. And mileage is the number one thing that is going to trip a business up. I can't tell you how many audits we go into. There's substantive recreation that you can do, and I'm pretty good at doing that. But even I can come back and say, we're not going to get 100% of the miles that you originally claimed. There's only been one case I've walked out with more mileage. So that was one of those moments that's on a calendar. But mileage is your biggest one to trip you up. It's the third grade essay: who, what, when, where, why, and how. And I think there must be another one in there now. So
Yeah, and there's some easy apps you can get, and you can track that on your phone. It's super easy, and then just on the back end, allocate it to whatever you're doing. So I don't really care if whoever is watching knows where I am, so I turn that thing on all the time and I track my mileage. And then on the back end, I can say this was for business, this was for medical, this is personal, whatever you want to do, because I'm driving around all the time. But there's apps out there that can track that stuff for you, and then you don't really actually have to rebuild it, which I have a feeling is not super fun.
on a regular basis, I wouldn't recommend it. Odometer reading typically is the beginning and end of the year. So if we're talking audit situation, you need a disinterested third party. So your oil changes, you get your tires rotated, you do all that minimum maintenance girls were supposed to do, but we don't always do. They don't care about the odometer reading on your car, and that's your third party, your disinterested third party. So that's great. Spot checking your odometer reading that you have, on your log. You don't need, from Fred's, it was 102,344, whatever miles when I started, and it ended on 102,355. That's not what that's saying, but you're definitely going to need to keep a track on those. So Google Maps don't always account for, it's more, they're getting a lot better. But I wouldn't 100% guarantee using that if you just need to get into the discipline of doing it. And what Mary said, the apps are great. The backside is you have to use them. I have an app on my phone, and I'm the worst mileage gatherer in the world.
Does anybody know what time it is, or how much time do we have left? 5 to 1. So if we want to stay back, you can meet each other and then figure out, it's always a networking opportunity, obviously. So find out what each other does and do those sorts of things. And if you have any other questions you want to just ask us one-on-one, then we'll be able to hang out for a couple minutes afterward. But thanks for coming.